Welcome to TheoTrade. This is Don Kaufman. September 9th, 2022. Just about 20 minutes left inside of this shortened holiday week of trade. SPOOs are up about 1.6%. Nasdaq on fire to the tune of about 2%. But hey, listen, before we go into any detail regarding this marketplace, obviously, in this week of trade, we've seen this rip and rebound. But here's why you cannot trust this market rally. Let's get right to it here on this weekend's update. We're going to make this short, sweet, and concise. All right. Everyone has seen the S&P's rebound. In this instance, I'm actually going to start here in the S&P futures. This is a daily chart. It's pretty easy to say. All right, so we saw unbelievable, just relentless move to the upside, followed by the exact opposite, what felt like the absolute bottomless pit. A very critical central point of trade happened to be the 39.31, something I've talked about just incessantly in some of these recent kind of update videos. Anyway, early on in the week, we exploded back to the upside. Here we are trading 40.72. So why? Why not trust this rally? And first of all, I want to make something just very, very clear. When I say, hey, this is why you cannot trust this market rally, that is not unto itself a bearish statement. I'm not trying to give you like a bearish connotation, based on the fact that I'm like, oh man, don't trust this rally, like you can't trust it. I'm actually going to show you other asset classes that have been playing just a critical role inside of the momentum, or well, lack thereof, in the S&Ps. And if you start looking at a number of other asset classes, you're going to be very, very concerned. Obviously, I've got them listed right here on your screen: bonds, dollar, energy markets, correlation, complacency, and volatility. We're also going to talk a little bit about a statistically insane move that we're seeing right now inside of the SPX, the mother of all products. All right, so let's give you kind of a brief overview here. Right now, when I say right now, I mean like this minute. Again, you got a few minutes left inside of the trading week. This kind of feels a little bit like what we term a gamma squeeze. A lot of the trade that we have seen as of late, has been, these terminology. It's a gamma squeeze, it's this, it's that. One thing I want to remind each and every one of you, just because we're popping to the upside, people turn around and think, there's buyers, baby, we're back, Mortimer, we're back. Has nothing to do per se with that. The idea and the logic of buying, is not what people kind of imagine it to be. And what I mean by that is, what can actually force, if you will, these S&P futures higher? Everybody goes, well, buying. Well, first of all, think about this downward momentum over here. Trading firms trade in the dynamic of the marketplace. If you think about trading firms, let's first of all talk expressly about market makers. I'll put them up there as MM, the market makers. Market makers, if they are adhering to a portion of the Dodd-Frank bill, specifically the Volcker rule, they're going to be very close to what we term delta, neutral, which means that they're what they term bona fide hedgers. That's the exact terminology used in the Volcker rule. And what that basically implies is they're just not taking a lot of directional risk. So if a market maker goes out there and we're in the marketplace and they're buying and selling, bottom line is, if the market starts to move down, the market making firms, and again, this confuses a lot of people, they have to sell, into selling. Why do they have to sell into selling? To actually balance their delta. So if markets start going down, they're actually going to be selling. What are they going to be selling? Well, predominantly the easiest way to actually balance your risk is turn around there and sell like S&P futures, sell some Nasdaq futures, depending upon where they're effectively making markets. But if you look at a firm like Citadel, which of course does millions and millions of option contracts a day and trades futures contracts as well, I mean they're going to sell into the selling, so they're trading with the dynamic of the marketplace. All of a sudden, we get down here. We get a few people that are, if you will, covering their shorts. What's covering the shorts? Okay, it's buying. So all of a sudden you turn around, you start to see some buying, and guess what? All the trading firms, they turn around and have to start trading in the dynamic of the marketplace. It's one of the reasons that lately, and again, in volatility, it really exposes this, but as of late, okay, look at the marketplace. I mean, this thing is what I would call trend worthy. We go down, it feels like forever. We have some bounces, we go down, it feels like forever. We have wild rallies in here. I mean, the bottom line is you just do not want to get on the wrong side of any trend. But again, what we're seeing at present time, and I'm just going to zoom in for a second, at present time, this vicious pop at this point in time is predominantly some short covering, followed by the fact that market making firms, once again, are trying to balance out some of that delta. When people talk about the terminology of like gamma squeeze, that has to do with, for instance, like, weekly inside of the SPX, we're outside the expected move, everybody turns around and buys into buying. It's the exact same thing. Okay, trading firms are just trying to reduce risk and inherently causes, dramatic moves, if you will, inside of a marketplace. And it almost feels, if you will, a little bit manic, and that's exactly what a gamma squeeze is about, especially here on a Friday afternoon. All right, but let's push all of that aside for just a second. I just wanted to give you a feel for what causes, these quintessential, if you will, rip your face off rallies. Okay, let's get down to business. And when I say down to business, let's talk about specifically, okay, why you can't actually trust this market rally. Number one, bonds, completely unstable. Let's actually bring up a chart of the bonds. All right, big sell side activity hits the bonds. It's almost unequivocally going to smash the Nasdaq. Okay, growth stocks. Growth stocks do not like bonds lower because bonds lower. What does bonds lower imply for interest rates? Okay, for those of you that do not speak bond geek, right? This is the Nasdaq. Okay, if the bonds start to sell off, it implies higher interest rates. Higher interest rates is no bueno, okay, for Nasdaq stocks. The growth stocks, this could actually come off hard and fast. Why my concern right now? And again, when I'm talking about the market rally, as I said, I'm not sitting here going like, oh, we can't rally. Of course we can rally back up. We have rallied back up. I wouldn't trust it as far as you can throw it. First of all, if you look at a chart on the ZB, you should always come over here if you're on thinkorswim, come over to futures contracts, okay, adjust for contract changes, hit apply, hit OK, especially if you're in the technicals, because again, the low that you're looking at is not the right low. We actually have contract rolls, okay, and this creates what they call a continuous chart. With that being said, right, do you have any idea what the Nasdaq's going to do, okay, if the bonds come under the 130 handle? Do you have any idea? I think I do. I think that it's going to be bye-bye Nasdaq at that point. You're like, oh, this week we were actually teeter-tottering with the the 12,000 level. Okay, you better be careful here because you start to see the bonds break through like 130. I mean, what? You're only 3 points away from seeing the Nasdaq get sucked into an oblivion. You can see the Nasdaq down, okay, in the low 11,000 handle in no time. All right, again, the bonds critical. And I think that they're at actually a really critical level right now. You should feel the fear on this one because all it's going to take, you wake up on a Monday morning and the bonds are actually, breaking for the downside. It's edgy. Now, does that imply that the bonds are going to break? Absolutely unequivocally not. Okay. But I'm just giving you a reason. Hey, this is why you don't trust the rally. Bonds are unstable. Instability in the bonds, not going to be good for you. The same exact thing is actually true of the notes. The notes, this is the 10-year. This is not far off of actually breaking some of the recent lows. Okay. And again, if you take a look, and I'll zoom in here, all right, what day did the notes hit their recent lows? The day is June 14th. Go take a look over at the Nasdaq. Okay. What was Nasdaq doing? What was Nasdaq doing on the day of June 14th? Basically sitting at lows. Okay, it was like a hop, skip, and a jump away from it, but that's the point I wanted to make over here. So right now, you're on this rip your face off rally and everybody's starting to high five one another. I mean, you got to realize if you look at the S&Ps, Okay, you're what? You're 3 weeks removed from the fact that people are already talking about meme stocks again, and all of a sudden here we are like, oh, I'm back. Okay, you're not back. You're definitely not back when the bonds are actually threatening lows. I think that that's one of the critical aspects. Number two, line it up, the dollar. Okay, I don't trust it as far as I can throw it. The dollar absolutely backed off this week. Okay, the dollar threatened to move lower. Oh, again, we're a hop, skip, and a jump from the dollar exploding through the 111 handle. We explode through the 111 handle. It's over. Okay, I mean, I don't really care that the marketplace is rallying back right now. Where you've got the bonds, where you've got the dollar, I think it just compounds risk. I think it's an incredible amount of risk. Now, I'm not going to sit here and pull up technicals on here. It's overbought, it's oversold. I don't really care what you think about this price action. Okay. The bottom line is if you are into technical analysis, listen, the dollar hasn't really had much of a downtick, okay, all year. It hasn't broken trend over here. It hasn't done anything. For the most part, it flinched. I think it moved. Okay, but it's just been a straight arrow to the upside. There's no reason at this point to actually believe that we're going to sound the all clear on the dollar. Hey, listen, I'll be the first one to say the dollar gets back to maybe 107. Hey, let's get crazy. Maybe let's get bullish in the S&Ps. Okay, but we're nowhere near that. And again, I cannot reiterate enough. The dollar would have to come all the way down to like the 107 or even 106 region before I'm actually going to buy into the idea that we're going to rally. At this point, okay, this rally, can't trust it as far as you can throw it. Now you've got the bonds coupled with the dollar. Ooh, next thing, energy. Energy is going to be the talk of the town this weekend because, well, the powers that be in Europe are actually meeting in Brussels. Why? You got yourself a little bit of a situation. Speaking of energy, the only market I'm really going to reference right now is oil. And the reason I'm only going to look at oil, natural gas is too convoluted. It's seriously like natural gas in Europe is priced at one place, or natural gas here in the US is actually priced another. It's all over the place. But, okay, mind you, I'd be very, very careful in oil. Oil at this point looks like it actually could explode back onto the scene to the upside. Okay, it has had a strong trend to the downside, and yet everywhere you look in the world, they're talking about an energy crisis. Okay, so the only argument for oil going down at this point would probably be because of a massive economic slowdown. But again, demand might still be there. This is an extraordinary and dangerous trade, I believe, at this point. Normally, I wouldn't even have thrown energy into this complex over here. By the way, energy markets, specifically, I am looking at oil. If you look at something like the XLE, okay, the XLE has really, it's decoupled substantially, okay, from oil itself. Like XLE is like, this thing could actually hit all-time highs in here. In fact, you got to start pulling up like 10-year charts to see what I'm talking about with all-time highs. I know you thought 90 was the all-time high, but wait, there's more, okay? You can see energy products come into all-time highs in the XLE, and I don't mind saying this. I'm actually in a short position in the XLE. I'm comfortable in there at this point because it's decoupled so substantially from oil, okay? But, okay, oil smashing back to the upside would imply, once again, inflation, okay? If oil starts to rally back, and again, I think that today may have actually been the turn for oil. Oil starts to rally back, look out. They're going to start beating that drum for inflation once again, okay? All right, onward and upward from there. There's one other factor in here that really, really bothers me, okay? If it's not the bonds that do it for you, if it's not the dollar that freaks you out, okay? I got to look at like the high correlation inside of the S&P 100. We've been in a totally correlated state pretty much throughout the course of this week. We've seen in the S&Ps what I kind of term as some manic moves, not just to the upside. We saw some manic moves obviously to the downside, but the state of correlation is extraordinarily high. And what I'm referencing on this particular point is, you know, a lot of people, they'll comment and they'll come in here and they'll be like, Don did not talk about Apple. He didn't talk about individual stocks. I don't really care about individual stocks. Want to know why I don't care about individual stocks? Just look right there. It does not matter. Everything is moving in confluence. At one point, and I just want to show you something very interesting about the S&Ps, okay? At one point, okay, literally 2 days ago, we're all the way down here about to break, you know, through what? You know, possibly what? 3,900 happened, but we're about to break apart. Even yesterday, which is Thursday, we were actually about to hit the 39.31 again. What's interesting is to the downside on both of these days, we had over 90 products to the downside. On an up day, we have over 90 products to the upside. Everything we're seeing right now, okay, is just these mass, if you will, manic type moves, okay? And nothing has changed in today's trading session. Right out of the gate this morning, strong correlation. It doesn't get much better than that to the upside. Anything down right now is an anomaly, okay? Starbucks, nobody likes that. But anyway, anything for the most part is a bit of an anomaly. Everything's actually trading as one unit. And when you're in a high correlation like that, okay, one thing that it reeks of, okay, is volatility. We get substantial, okay, market moves when everything is correlated. When it's a 50-50 swap fest out there, you can't get out of your own way. Okay, when the market though is actually trading, 90 products on one side will explode higher. 90 products on the on the downside, we're actually taking off to the downside, and we've seen this time and time again. That is actually one of the hallmarks, if you will, of some fairly extreme volatility. All right, now this should also be a little bit of a warning shot being fired. Okay, you're just what? You're like a day. You're a day off. 39.31. Volatility is actually already collapsed back down to 22. The market is literally telling you, I've seen this movie before. Look at the VVIX, the volatility index. You realize it's back at 83. Okay. Now I made points in the last couple of weekend updates of why low volatility or complacency in volatility alone generates fear in the heart of me specifically. I look at like the volatility futures and I'm like, oh boy. Okay, I mean, look at this. And these volatility futures here, and again, forget about like 12-day volatility futures, the toast, right? We start talking about volatility futures. I want you to look out a little further in time. Okay, look at like 40-day. And again, I'm just going to freeze the screen right now. I don't care how much time is left in the trading day. I'm going to freeze the screen and I'm going to make a couple of points. First of all, only look at volatility futures that have volume, right? I would look at like these 68-day vol futures and I would look at the 40-day. All right, this is OC versus NOV. What's the point I'm trying to make? Okay, look at this. We're still in a really substantial, if you will, contango, meaning that, the proverbial, crap has not hit the fan lately in this marketplace. We're nowhere near that. Again, there's this incredible complacency, even though, okay, this is a manic move in the marketplace. I mean, we're trading 42.11. We collapse down to the 39.31. We explode back up off of it. Again, bonds right now look like they're absolutely going to fall apart. The dollar looks like it's going up to never, never land. And meanwhile, the S&Ps, okay, you just shake your head, keep on moving. But the volatility just almost doesn't feel right. And I'm going to make that point here in a second. The complacency and volatility, it doesn't feel right. And when I say it doesn't feel right, what doesn't feel right? Okay, I think we're moving way more than the option marketplace in the short term is giving you credit for. What I mean by that, and I want to be very, very specific because it's very infrequent that I take a side of the marketplace like this where I say markets right now, in my opinion, are doing a piss poor job of handicapping risk in the short duration. I very infrequently will say something like that, but to further that, statistical insanity with expected move. You need only look at our SPX chart. And SPX, I'm actually measuring what we term expected move. For those of you that are a little newer to TheoTrade and you don't speak total option geek, let me explain you something what an expected move happens to be. Okay, option markets on a week-to-week basis, like here, 7 days from now, this is exactly 1 week out, we're expecting a $97 move. Let's just round, let's call it 98 bucks. We're expecting this $98 move. Okay, and that's the way that the option market is handicapping risk. And people go, well, it's an equation. It's not an equation. Well, it is an equation, but it's basically averaging all of the options in the chain together. And you average all the options in the chain together using implied volatility, a little bit of math, divide by the square root of time. Okay, it's actually 7 days divided by the square root of 365. What do you got? It basically says we should move 98 bucks. But all of a sudden then we move, at the end of the week, if we move, for instance, 150, you go, holy crap, that was wrong. I mean, this, statistically speaking, is crazy. What's crazy? Let's go back and look. And I'm going to zoom in. And you know what? I think it's not a large enough, data set over here. But look, there's 1, 2, 3, 4, 5, 6, 7, 8. 8 weeks. 8 weeks. We got 1, 2, 3, 4, 5, and today is 6. 6 out of the last 8 weeks, we've actually smashed through expected move. Okay, there's nothing small. This is a 2 deviation move. Look at this. 2 deviation move right there. That's a breach. That's a huge breach. Okay, this one, oh, all right, but it's still breached. This is a big breach. There's nothing little about any of these statistical moves. And yet, again, markets are doing a piss poor job of kind of handicapping the risk in the near term. The only options you can sell right now are going to be in the back month. The back month is doing a much better job. You see implied volatility is considerably higher further out in time. Nevertheless, what does it mean? Well, I'll tell you exactly what it means to me. You have degrees of inefficiency of markets that are like, the only way to explain it from my perspective, markets are getting pulled apart at the seams. They're getting pulled apart at the seams. And at a time like this, you've got bonds displaying that they could actually break lower. You've got the dollar that can almost like, vault higher, if you will. This is not a time to be taking extraordinary directional risk. This is a time. Go out, sell premium, get back, reduce risk where you can. If you are going to take directional risk, here we come into the closing bell. That's the week, people. If you are going to take degrees of directional risk, use spreads whenever and wherever possible. I'm telling you right now, you look at this marketplace, we got issues. We got big issues. Okay, the issues come from bond instability. We've got the dollar screaming that could actually break to the upside. You've got an incredibly high correlation. You've got this complacency and volatility, which just makes me think like it's not often that I say, hey, the SPX is doing a terrible job of handicapping risk. Okay, all of that, okay, all of those factors compiled is why you just cannot trust this marketplace, and you cannot trust this rally right now. Speaking of the SPX, to kind of wrap things up on this weekend's update, this last week, we had a $94 expected move. Now, I realized that we only had a 4-day trading week. We smashed through, okay, that expected move, meaning we were looking for a $94 move. What do we end up with? Okay, well, right here, we were what? 39.25. We're actually trading 40.67 into the close over here. Tried for the corner and missed. I mean, this is a ridiculous move. And most of that actually transpired what? In 2 trading sessions. Nevertheless, again, keep your wits about you because this next week of trade, which will include triple witching. That's right, people. We are coming into a primary expiration in September. The futures contracts are going to roll over. The big SPX settlement and the AM settlement. Okay. Nevertheless, we're looking at just shy of $100 expected move. Again, just shy of $100 expected move. So what's the take from that? Listen, the take is volatility is here. Volatility is going to stay. Okay. Keep your hands and feet inside of the vehicle at all times. You can't trust this marketplace. You cannot trust this latest rally. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.